All right, welcome back to Business, and we are still looking at that Seasonal Investments report that says that the banking sector is reeling as a result of the COVID-19 pandemic. So Rodney, I want to bring you in on that as well. If you do know very well that some of the bosses of these banks have been complaining that the regulator, that is CBK, has taken a customer approach when it comes to running this sector. So my question for you this morning is that do we expect any regulatory approach from the regulator in terms of securing the banking sector from these massive losses that have been occasioned by non-performing loan books and restructuring as well?
Sorry, Elijah, you're on mute.
All right. Can we get the mic unmuted? Are we good now?
Yeah, we're good now. Yeah.
All right, it happens, man. Douglas, good morning. It's time to wake up, man. Anyway, so my question for me to you, Rodney, was, do you expect that the CBK is going to sort of push any regulatory approach to the sector that is going to sort of, I would say, cushion the industry? Because they have been blamed, the CBK has been blamed in the past for taking a customer approach as opposed to an industry approach.
Well, I'd say they've tried to so far, in the sense that they've cut the policy rates, making it a bit more affordable for all these banks to access money. They've reduced the CRR such that there's liquidity, so banks have more money for onward lending. And similarly, they've sort of given guidance in terms of the restructuring that's supposed to take place. So in the sense that banks will be allowed certain portions that meet certain conditions. In terms of the cost for this restructuring, most of it will be taken up by the banks. So there's sort of been a proactive approach to try and mitigate the situation or try and manage it early on. So there's a move, but I feel like there's still more work to be done in that space.
Yes, Rodney, before I go, somebody would say, they have been saying, well, just giving me more money to lend doesn't mean that essentially that it's going to bring something when we're talking about massive loan provisioning as well.
So what I can say with regards to that is, like we've been mentioning NPLs from back in 2019. So what we've been seeing is back in November, the rate cap was removed. So banks were allowed to increase their rates, but that lending towards the private sector wasn't as high as it was as expected. So there was a bit of a slow uptake, or that's how I'd term it. Then come COVID, they perceive the increased risk in terms of your normal customer. So for banks to lend, it will definitely take some time because of that perceived risk. So they're a bit shy in terms of lending. So I feel like onward lending at this moment might be hard, but I feel like that's where the government should sort of step in and try and find a way of making sure these funds ultimately reach to all the struggling businesses that we have.
Yes, my next question to you, Rodney, is going to be in relation now to the interest rates, because I'm very aware that you've seen some of the bank CEOs also complaining about that they haven't been allowed that sort of, I would say, leeway to sort of price their facilities properly, because the average has been 12.85%, which, as you know, is just even lower than during the cap rate regime. I just want to bring in Gabriel on that as well, just before we come back and answer that question as to whether we are going to see more expensive credit as we get into 2021. Gabriel, any sort of regulatory approach that you expect from CBK, since we are talking about massive losses and massive loan provisioning?
So I wouldn't choose the word losses first, but as far as CBK goes, I took a different approach in looking at what CBK would do. So I think we've been focusing on what CBK is saying while not looking at what the bank actually does. So what I did is I looked at the bank's income statement and balance sheet and tried to pick out the things that CBK has a hand in. So if you look at the cost of funding, previously, while under the interest rate cap regime, CBK had put a minimum on which a minimum deposit rate that customers had to be paid. So that has been taken out. So at least we can say CBK does not have a hand in that. And that's why the customers don't get much. I mean, about 2.9% is the cost of funding. So even when banks are lending at 12.8, a bank like Equity Bank, their average cost of funding is 2.9. They still have a 10% profit margin. That's okay. Now, the cost of loans, as much as there's no interest rate cap, CBK still has somehow some control around this. So that's the first thing that CBK has a hand in. Non-funded income. These are the transactions and the commissions banks get. Again, CBK has a hand in there. They have said that, no charges will transfer into M-Pesa, etc. So that has already been affected. The next thing is employees. At least this one CBK has not come into. So it's one of the few things that has been left to the bank's discretion, whether you dismiss some, whether you hire, how much you pay, etc. That one has not been affected. Rules on provisioning of on the loans. Of course, there are the base regulations on this. How the criteria of provisioning on loans, and I think it's been open enough for banks, and that's why you can see they can play around with it. And what people actually don't know is that KRA doesn't like provisioning. Most people don't know that because it hits the profits and hits the taxes. And KRA has been known, I think it was in 2017 or 18, to actually require that banks reduce their provisioning. So you see, there are contradicting sides from CBK and KRA. That's the other thing. Then there's the dividends. We've seen CBK try and request some banks to not pay dividends. So that's another area that CBK has a hand in. Now, the things that they do not have hands in, the next one is the loan to deposit ratio. So the deposits have been growing if you actually look at the deposits that are held with banks. And what this tells me is that people have actually liquidated some of their long-term assets elsewhere and actually increased the amount of cash they're holding. And that has been seen in the rate of deposits that are grown by about 18% or thereabouts compared to about 10% last year. And last year, remember, we had the big tax amnesty that saw quite a number of inflow in cash. So deposits are growing, and that's something else to look at. So if you look at it, there are very few things that the CBK already does not have a hand in. And I don't know what more they can do, honestly speaking. Or should they back off, or should they just... So they're going to eventually have their hands in everything, that there'll be nothing left to do when the real problems come. So that's really where I stand. There are a few things they're controlling, and there are few I feel they should let go, like controlling the rate of borrowing. As a borrower, I'm happy they keep it where it is, but it doesn't do well for banks and their shareholders and their ability to price risk. Yeah.
Pretty much. All right, Rodney, just clear for us this conversation this morning just before we let you go. So there's this general optimism that, yes, we are going to bounce back. So from where you're sitting this morning, when are we going to start seeing a turnaround in the fortunes in the banking sector?
Well, ultimately, it's not like clear December or 2021, but subject to how the COVID situation goes, we are seeing a bit of improvement. The Q2, having considered what we saw earlier this year. So going forward, we expect the situation to change as businesses continue to reopen. So money sort of comes in more and more as opposed to what was happening initially. So going forward, we expect a bit of improvement, though not in the short term. We're looking at 2021 onwards. So that's the move we are considering. Also assuming that some businesses are still going through these tough situations currently, and the year isn't over yet. So for us, it's sort of a wait and see, also subject to what the CBK will try and do to make the situation better for all the businesses involved, both banks and all the industry players. So we are a bit optimistic, but at the moment we are a bit conservative in terms of how fast we'll recover.
Rodney, 10 seconds just before you step out, maybe more than 12.85% average interest rate?
Highly unlikely.
Yeah.
Rodney, I'm just going to leave it there this morning. I like that, high unlikely. Thank you very much. All right, now the 2020 Kenya Association of Manufacturing Sector Mainstream Gender Inclusion has recognized that while women are not explicitly excluded from the manufacturing sector in Kenya, they remain both underrepresented and undervalued. Now, the report indicates that although there are various opportunities in the existence for women to engage in the sector as entrepreneurs, industry leaders, and employees, there is lack of sufficient data about the status of women in Kenya's manufacturing sector. Gabriel, so how integral, let's understand it, are women in driving industrial transformation for job creation and inclusive economic growth? Let's talk about it from an investment perspective this morning.
Yes, good. I think I'd first like to commend, of course, the Kenya Institute of Manufacturers for coming up with this report, because data is the first point of making any decisions, etc. So it's very good that they did this survey. I'd like to say that it's impossible to ignore women in this country because of, first of all, even by their about slightly over 50% of the population. It's impossible. You cannot ignore them in any sector, no matter how hard you try to. Now, from an investment point of view, and I think this differs across generations, to be fair, because, for example, if you asked my dad how many women he knew during his time, who were either involved directly in management in manufacturing entities or owned a manufacturing operation, he might name just a few. But personally, I can name quite a number who I know who are engaging in different sectors in the manufacturing sector, who are employed in that sector. So it's really growing. And because of the property rights that we have in Kenya, because that's the first starting point that you have to look at. Who owns the money, who owns the assets? That line has been very proactive in ensuring that women are not disenfranchised in inheritance, in generating income that is then invested in this manufacturing sector. And that's why we can see that women have become more empowered, and they're actually taking the forefront in establishing, controlling, and managing some of these businesses. So just by the fact that we've tried to not restrict anything from the property rights, that was resolved, I think, a few years back. Now we can see the impact with more women taking part in this manufacturing space. And it's hard to, because, okay, I'll give an example here. I walked to asked the guy why the assembly side, all running the heavy machinery, was all men. And he told me, come, let me show you the package inside. And it was all ladies. So we can't, of course, force them to come and run heavy machinery, but their involvement in the manufacturing sector is more than evident. From the accounting side to the marketing side, all these are still jobs in the manufacturing sector, and they're actively involved, that I'm sure of.
Pretty much. Now, one of the biggest challenges, therefore, affecting women in manufacturing is operating informally. But this is also a problem affecting SMEs in general. What does the government need to do to entice and enable small businesses to formalize their operations? Because, and I want to point you out to very interesting data that we're sharing this morning. If you look at the contribution of the manufacturing sector to the GDP, it is on a decline, has been on a decline, and we're still approaching even lower numbers. Would you point that to be the problem, that is also now therefore underrepresenting women, I would say, in the mainstream manufacturing sector?
So first thing is very few informal. That's the first thing we all have to appreciate. Some of these informal companies are not that keen on becoming formal for obvious reasons. Taxes, the fact that they're now in the eye of the government, you have to get the right certificates, etc. And it's an uphill task. So that's the first challenge that we have to appreciate. So some businesses do thrive when they're qualifying as informal, etc. Of course, it's harder for them to get capital. That's why you have the chamas that women are now thriving in, and that's why you can see their impact in the informal side, because women also have much more informal sources of capital. So, you know, the chairmans, etc., they do support each other. So you can see the impact of that in this. Now, as far as manufacturing goes as a percentage of GDP, yes, it's been on the decline, but I believe that is because GDP has also been rising pretty fast. I mean, the growth in GDP has been quite steep, and it's unfortunately because of government spending on infrastructure, etc. Which,
Gabriel, would you say that would be the reason as to why it's not really contributing that much? Because there's also this stress from the government to enable the manufacturing sector to also contribute heavily on, especially if you look at the Big Four agenda, the manufacturing sector is heavily stressed upon.
Yeah, so it's stressed upon, but government cannot invest directly in manufacturing. I mean, as a private party, I have to see the profits, I have to see the business opportunity for me to deploy. So, for example, affordable housing is yet to really pick up, which would have, of course, helped the local construction industry. That's one. Two, a lot of, like just sticking within Big Four, healthcare, a lot of the stuff is imported. There's only, I think, one big manufacturer in Mombasa who does most of the syringes and all the lab and medical equipment. Food security is, I mean, it's very subsistence, and then it's classified under a different sector of agriculture with very few and little value chain additions. So manufacturing, if you look at it, and we've actively actually done quite a number of investments in that sector, it's controlled by the private sector fully. So unless they are, there has been actually a rollback of the tax incentives for this sector. For example, the power. You remember manufacturing companies were given an incentive on their electricity bills. That was just taken away. So these are some of the small things that eventually end up not encouraging. So to answer your question from the government side, there are some of the small things that they had given, that some of them they have taken back, that are not helping. I mean, if you walk into a manufacturing entity, the first thing you see in the office is a wall full of certificates, and the NEMA people working there every now and then for spot checks. So the regulatory environment has not come up with anything I can call specifically tangible to drive manufacturing in any sector. I mean, we've seen rollback of taxes for tax incentives, even for plastic recycling. You know, some of these small things that eventually does not help some of those subsectors in the manufacturing space.
Pretty much. Now, the report also found out that women working in the manufacturing sector reported that policy formulation was not gender responsive within manufacturing companies. What do you think this pattern exists? And is there any recommendation that you can give some of these companies and policy makers on what they can do to improve policies around gender representation?
So let me quote, and I think if banks, for example, and I'm happy to quote DTB Bank, because some of these banks have received international investor funds, like DTB I know has received, and it's in the public domain, IFC money. Now, some of these DFIs actually require the companies that the bank lends to have a certain proportion of employees as women. So there is actually a push from the private, some of the private. For example, a company that has more women than men actually qualifies for some sort of better financing, or they score better on the impact side, and actually puts them in favor with some of the financiers like East African Development Bank, Africa, the likes of Propaco, Norfund, all these DFIs. Actually, you actually score very high when you have a higher proportion of women. And I kid you not, that in itself, by the source, the people who are actually providing a keen interest in the number of women you've employed, not only about the number of people you've employed, has actually increased significantly the interest by manufacturing companies to hire women. And that is happening on a daily basis. To the reports you provide, it is a question that I am seeing on a daily basis to all the level of financiers. So this has now become inculcated in some of these businesses, and that's one of the very key ways. So it doesn't have to come from government, yes, because that might be ineffective, but from the providers of capital, it is there.
Pretty much. Now, Gabriel, do you think, therefore, that if Kenya had a robust legal and policy framework that lays a foundation for manufacturing and mainstream gender inclusion, that this morning we couldn't even be talking about this? Because then it looks as if it's left for the companies to try and give us this image, as opposed to saying, well, if you got to operate within our economy, this is the sort of representation that we need to see before we give you that certification.
I mean, Elijah, we've tried this with one company I'd like to call, but it's not worked. They're the ones who are supposed to set the laws for themselves. They're the ones who, they're right there. Everything is within them, and it didn't work. So I don't think apply it across the sector. I mean, that's the best evidence I can give you, honestly. And you don't want women to be employed to just fill positions and meet certain numbers. You want them to be employed for skill, and that has been happening. And I'll quote Thomas Sowell here. He says, stop solving problems that are not there. I mean, if you look over the last 10 years, increasing without that regulation from the government, it's been increasing naturally. Because, for example, I started in Jomo Kenyatta University. It was a university termed to be one that is full of boys. But in engineering class, that is done, I imagined I would find. So there's a natural solution to all of these things, and it's been happening. And the fact that Parliament couldn't solve its own crisis, I don't think recommending some policies for the entire sector would work, unfortunately.
Just in your own words, stop solving problems that do not exist. Gabriel, thank you very much for joining us this morning on our show.
Most welcome.
And that's exactly how we end the show. I'll say it again. Stop solving problems that do not exist.